Ladies and gentlemen, we are live ahead of a historic Fed Powell speech. The Fed just decided to keep rates steady. This was announced, from Powell giving his speech. This is a big one. This is the second to last Fed speech we're getting from Powell. Pardon me for being late. Are you feeling a pardon me? No pandemic is the truth. Wait, I'm not holding no pandemic through this whole thing. I have cells for no pandemic locks here. Are you really on no pandemic? I think pandemic's gonna hit. Exactly. I'm just buying it to decay flip, by the way. So don't assume. I actually think pandemic is gonna hit. It's purely I'm just trying to decay flip it. That's why I didn't even mean to show my position. So I have cells up to sell live. I mean, just because I'm trying to. Okay, don't try to copy that though, because then I won't be able to sell. So let me exit. But Fed just released their statement. Only one person dissented, which was kind of a surprise. I think people thought two would dissent. It was just Stephen Moran. Do I think he's going to talk about Iran? Well, in the statement, he explicitly highlighted Middle East. I think the better question is if he's going to actually say Iran. Oil, I sort of feel like is a bond. But Iran's an interesting one. It's at like 60-40. Let me find Iran. Iran, yeah, now is a 60-40. The big question with Iran of why it's interesting, I don't have a position on it, but, he obviously tries to stay non-political, doesn't explicitly call Trump by name whenever he can. So it's going to be interesting to see, and I'm very curious if he actually says Iran or not. He's historically, when it comes to like Russia, Ukraine, he'll say Russia, he'll say Ukraine. But the question today is if he's going to explicitly say Iran. The reason, like, he used to always say Russia, Ukraine. But if you think about it, that's a little less political. It's talking about other countries fighting, not the U.S. kind of fighting. And then the other piece is when talking about Iran, he has an easy other word to use, Middle East, right? So I'm very curious. It's hard. This is such a hard word to actually predict because we don't have like historicals, obviously, of like how Powell's going to address a war. But I really do think there's a chance he's going to weave it. I'm not, that bullish to where I'm going to buy at 40, but it's interesting. Why are median and projection at 99? The Fed's going to be showing new projections here at this meeting, so it's their bonds. I tried to buy it at 97. Prefer gas over oil, better odds. Likely going to be questions, better buy after decade. Yeah, I mean, at current prices is probably better, but like oil to me is like, oh, how does he possibly not talk about oil? I mean, I honestly consider bonding it at 90, but I guess 90 is probably fair. I was getting filled at like 75 for a tiny bit a little while ago, but stopped, couldn't fill anything. So honestly, on this whole Powell speech, guys, like, somebody was asking picks. I don't have any like positions that I'm really big on going in pre-market. I guess if I'm gonna like enter stuff for Powell, it's gonna have to be live. I think this Powell market is so efficient. I've never seen it this efficient. It's kind of scary. Like the fact that projection, median are all bonded already is just crazy. Like you can't even fill at like 95. Oil will likely decay. Yeah, probably. So, I mean, I'm going to enter most things live. Hopefully things will decay irrationally or whatever. I mean, there's just not much for me to like love here pre-market. Yeah, Paul, I mean, I think he's going to say pandemic, but it's not going to come up till Q&A. So if you're on the yes side, you can kind of wait till maybe after opening remarks. Hopefully it comes down a little bit. But that's where I think like the fun part's going to be is like when we get to Q&A. Look at what dollar is at. Is there a strike for him saying dollar, or just like the dollar is declining? Are you saying because the dollar is back to... I actually don't think they're going to get, unless something crazy's happened. Is the dollar moving right now? I don't think he's going to get that many questions on the dollar. It made sense why he'd get, him to say dollar? I didn't even know they added that as a strike. Is that like somewhat bonded, or is it pretty... 38? I honestly think that's kind of reasonable. That's probably pretty fair. Paulie is $2 plus. Okay, here we go. Here's Powell. Good luck, everyone. I'm on no for that radar.
Good afternoon.
Good afternoon.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain.
Why is this lagging so much with that?
We will remain attentive to risks to both sides of our dual mandate, and I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down
projection and median
thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall
Federal Reserve
inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks.
There it is.
In our SEP, FOMC
Balance of risks. Okay.
participants wrote down their individual assessments of an
ready if he
appropriate
dodged
path
it
of the federal
there.
funds rate under
Pick some up on the nose.
what each participant judges to be the
This is
most
on
likely
YouTube,
scenario
Fed
for the
Reserve, by the
economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
All right, here we go. For the Q&A. Survived on the pandemic.
Thank you. Colby Smith of the New York
Try to avoid pandemic.
Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture?
Still
And to
a
what
dodge
extent
on
does the
gas.
fact that inflation has been above target for roughly
Kind of interesting. I didn't.
5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have
Shock.
interrupted progress that we've made over time, and that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is
I
progress
can offload some of my
on inflation through a reduction in goods inflation.
Goods inflation. Damn, man.
As
I was going to try to
the
buy that
one-time
live.
effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise, and we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total inflation,
People are already
sorry,
kind of
total core
dumping
inflation,
there.
it's about 3%, and some big chunk of that, between a half and 3/4, is actually tariffs. So we're looking for progress on that. The question of
Yeah, I know. Goods inflation already hit.
whether we look through
Look,
the
Phantom, all
energy
I'm trying to
inflation
do
doesn't
is
really
hold
arise
him
until
not
we
saying
have kind of checked
pandemic
that
for a little
box.
bit so I can
It, of
flip
course,
out
is
of it.
kind of standard learning that you look through energy
So,
shocks, but that's always been
feel a
dependent
little
on
bit
inflation
Without saying pandemic. If he says
expectations
pandemic
remaining well
early,
anchored.
I'm
And I think
completely
now it's
erased.
also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the SEP, can you help us make sense of why there is still a bias to cut from most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? I'm just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially, it is that the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year.
My mic kept going.
Progress on tariffs,
Yeah, people-
going through once, and then tariff inflation coming down. We should
Tariff inflation. There it is. Damn
be
it. I was
seeing that.
waiting for it to...
And the rate
I can't believe
forecast
that
is
went down to the
conditional on the
30s.
performance
God damn it.
of the
I was gonna
economy.
buy
So
that
if we
live.
don't see that progress,
strike
then you won't
always
see the rate
goes
cut.
so cheap.
Howard.
Thank you. Howard Schneider with Reuters. Just
Please don't ask
to
about
follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. Yes, but no, there's also just the feeling that we haven't seen the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy. It just takes some time.
It wouldn't have hit in remarks.
And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a
gas
potential
is getting so damn cheap.
to consumption and growth coming in the form of wealth effects with the stock market
I'm gonna maybe start
down, in the form of gas prices, diverting spending from other parts of the economy.
So I didn't get the second part of your.
The consumer's going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there. They can
Well, let's see if he doesn't say gas here.
wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure your position
Damn it, I
in
only
case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction that. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption, that'll weigh on disposable personal
I only got 200 shares. I was trying to
and it'll weigh on consumption.
Every strike that I'd like to accumulate live is hitting early. So what am I going to do?
We might have much lower than expected pass-through.
Damn
so
it.
People write down
like goods inflation,
this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. And we don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that just because you don't know. It's brutal. So unclear what the direction from this particular end will be. Meanwhile, the economy growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is...
oh, no, is this softening? I was going to guess.
Unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs with little growth in either demand or supply. But the U.S. economy is doing, pretty well. It's just we don't know what the effects of this will be, and really no one does.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increase to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So,
man, Iran.
The first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was
what the staff is.
Balance sheet was always said stream flow though, because they were in.
So there'd be an offset.
QE,
So that's
careful.
True. We have we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for
AI,
the war.
Nick.
And they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling.
So
whatever they're going to make a reasoned, careful judgment that we're going to have higher
entering because this
oil prices for an extended period, but meaningfully higher. So I wouldn't say there's much of that happening.
So kind of holding on.
Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that, having looked through tariff inflation and inflation running above target and looking through the oil price shock, would undermine the credibility of your commitment to the 2% target?
You know, we have to do our analysis
shutdown
and you know, think these things
Jesus.
through carefully, but of course that's on everyone's mind. You know, we're well aware of the history.
Q&A should last
but you
till
don't
right
want to
before
overreact to that. You know, you want to
3:30
make the best judgment you can
Still
based
got like 45 minutes.
on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had, you know, we had the tariff shock, we had the pandemic, and now we have an energy shock of some
There's pandemic.
size and duration. We don't know what that's going to be, actually. And, you know, it's one of those things where
Hit it
it's
so early. No.
it's a repeated set of things, and you worry that that's the kind of thing that can.
Man, my strategy for this
can
going
cause
live,
trouble
all
for
my
inflation
the
expectations.
strike I was
And-
trying to flip, hoping he would hold off through Q&A. It was so
we
close
worry
to
a lot
50
about that,
cents
and we're,
to
you know,
take
we are
away.
very strongly committed to.
But it makes
to
sense
doing what it
when he's
takes
talking
to
about all
keep
these
inflation
shocks.
expectations anchored at 2%. And you know, I think it's important that we do that. Very important.
Nick.
Nick Timmeros,
Wow.
The Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate
We
is
got
roughly
so
stable,
close. I had
inflation
my bid set at 50. It was at like
moving
46.
sideways in the high
It was
twos,
ticking up.
with an ongoing overshoot
All
in
these
services
talks
and
of shocks makes
non-housing services,
lot
not
of
just
sense.
goods, and the economy doing fairly well, as you
it's very risky.
just outlined. What gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive,
Oh, there's restricted.
even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers. On a one-time basis, and we're waiting for that process.
Wow, what
It
happened with QT?
takes 8, 9,
Someone
10,
bought
11
this up
months,
to
a year
88?
to go through the system, and we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system, so that goods and inflation will return closer to what it's always been. I mean, it used to be for many, many years. It was negative, and then the year before tariffs came in, it was 0, and it's running like 2% now. So, and so that's kind of goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor
Balance
market
of
are to the
risks.
downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates, or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now is just kind of on that borderline, the higher borderline of restrictive versus not restrictive. We feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much,
Yeah,
if at all, over
Iran
the
is
past year. If
I mean,
wage growth has
Iran's
come
so
down,
cheap
if the
because
labor
all
market
these
has
things
loosened,
nobody's-
why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Labor non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing. Because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services.
We're now
but
20
we're not seeing
minutes in.
progress there. So we do.
I know.
What we
No
expect for
parting
next year
of
is
the coffee.
continued.
It
What we
says
want to see
pandemic
for
early.
this year, rather, is continued progress on housing services. Finally, seeing that
Powell is not being good.
the goods inflation come back down because the
goods
one-time
inflation
effects of
like
tariffs are through,
5x.
and then it also get some help
I need
from
to study
non-housing services.
actual
That's what we'd like to see.
economics
But it's
Figure
it's a
some
good
of
question
these.
why we didn't see much of that last year.
Edward. Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January
Still
revised down. February posted a loss of
softening's
92,000.
getting
Is that
really cheap
is the
when
employment
you can get a lot of
side a far
labor
greater risk
questions.
than the inflation side? Because we are seeing inflation. CPI is close to 2%. PCE has ticked down overall.
You know, it's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and, you know, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, you know, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September.
You might say
that tells you that.
Slow down for what?
Inflation, you know, you can.
How have
we're,
zero
we're,
reporters
we're
said it wrong?
3.0% core.
I'm sorry, Carson. I already
Inflation
lost on
2.8%
We're all
headline.
losing
So
today.
we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, we're a full percentage point above 2% for some time, and that's a concern. You know,
This is
we
what
need
I
to
was
get back
scared
down
of
to
with Iran
2%,
was the whole Middle
and
East.
we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed.
Wow.
That
So
is
we
what the
may
law
get
calls
more
for.
Powell speakers.
That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether
This
I will
is
then continue
YouTube Fed Reserve.
to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution
Judy
and for the
Shelton
people we
bonded?
serve.
What?
Figuring you probably were going to set the dominoes off there. And I'm not going to have any more to say on those issues, by the way.
Wow, not going to have anything more to say.
Thank you very
not
much, Claire.
nothing.
Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
You know, it's really hard to say
Let's
until we
see how
see the
cheap
situation,
AI
the actual
comes down.
situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem
BLS.
from the projections or from the comments you've made today about the unemployment rate.
Shutdown is interesting just because they could
Focusing on
talk about
that
prior
your
quarters.
view
They're not
on
going to
the
talk
labour
about
market
DHS
story
shutdown now.
to a
It's not
large
really a
public-
shutdown, but they could talk about
and a
prior
supply
quarter
side
shutdown
story has
impacting
changed,
economic data.
despite the quite negative number in February. Would that be
kind
the
of
right
wait and
take?
see.
And was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. You know, in a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think a good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend in job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively zero net job creation in the private sector. But actually, that looks like
I know softening
that's about
is
what the
cheap
economy
that they talk
needs
about,
in
but
terms
he
of
keeps talking
dealing
about
with
the
very,
labor
very low,
market and not saying softening. That's where he's going to say
non-existent, really,
softening.
growth in the labor force, which of course we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but you know, I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So you know, we look at that, we see it, we get it, and I mean, everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless, it's something we're watching carefully, and so and you know, are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there.
Wow, I didn't even see
And,
where he actually said
But
dollar,
nonetheless, something we watch carefully.
what that was in relation to.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks, and
Stupid question
you know,
to
so
play.
we've had a lot of practice thinking about supply shocks in the last 4 or 5 years, for sure. And it's just a very different thing, and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But you know, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is
Now
a
he
one-time
says
thing.
COVID,
It's not
not pandemic.
because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that.
Man,
I don't know that
knew I wanted a Russia-Ukraine
world has
strike. I would
changed
have
in a way
bought
that
it in relation to all these
there'll be
other
more supply
strikes.
shocks, but you know, there's people
knowing
who've
they
written
would talk
that
about
paper
shocks
and
a
that
ton,
speech
but they didn't add it in time.
a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communications strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have, you know, have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we did.
AI.
And, I
looks like
I
it's
wish we
coming
had
down
been
to
able to do
55,
some things, but
interestingly.
you know, we didn't. So maybe the next
Will
year
he
we'll
dodge
take a look.
an
I'm
AI
sure he will.
question? I mean, we still have close to a half hour.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, you know, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be: there are a lot of goods besides oil that are trapped in the strait right now, and a lot of supply chains getting snarled. How much concern do you have
Fertilizer
about
also
whether,
going
if this
straight,
becomes
I've heard.
an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the
Yeah, what is
efficacies of
happening
monetary
with
policy?
QT? Someone keeps buying this up to, I guess I got to
You know, you can worry about other commodities. You can worry about all of the ways
How
that
much are they
oil
buying?
commodities,
Oh, I guess only
oil-related
500.
commodities go into manufacturing, that kind of thing. The truth is, it's completely out of our hands, and like everybody else, we have to just wait and see what happens, and it'll come down to how long, the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any
that. It's thin book.
way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa. Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean,
Hopefully
a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations.
Wow, he had dot
being right
plot
where they
down
need to be,
to
consistent with 2%. So that continues to be the
Does he ever bring up
case.
dot
We
plot?
didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth,
No.
but has there been any discussion of the risks of stagflation at this point?
Oh my gosh,
So people actually wrote up their growth forecast by a tenth, and that
I knew there was a
I
chance
think
of a
that's probably to
stagflation
do with
question.
just
Is he
growing
actually gonna hit it?
confidence in
I'm gonna be so-
productivity. But sorry, and your second question was just
If there have been any discussions about the risk of stagflation scenario.
Yeah, so
I was literally
as I
telling
mentioned,
people
there's
yesterday
tension
that
between the
stagflation was such a
two
good motto
goals,
with
right?
all the risks about it,
upward
and it
risk for
actually hit,
inflation
and I didn't have
downward
any.
risk for employment.
I was telling people not to bond stagflation.
And that puts us in a different situation. When we use the term
and I did not buy
stagflation,
yeses on stagflation.
I always have
I
to point
played
out
this
that
so terrible.
that was a
I can't believe
1970s
you actually
term
hit
at a time when
stagflation.
unemployment
I was saying,
was in double figures and inflation was really high
Why
and
didn't I
misery
just buy
index was super high added
What's
together.
the risk?
You get the misery index.
Man.
And that's not the case right now. We actually have unemployment really close.
Phantom, I'm sorry about
to
Iran. I'm
longer
not
run
winning.
normal,
I got
and we have
completely
inflation
wrecked on
that's,
pandemic.
1
I'm just
percentage
really upset about
point above that. So
stagflation.
calling that stagflation, it's not. I
Wow.
would reserve the term
I was
term
talking about
stagflation for
stagflation so
a
Why
much
did I
more
just buy
serious
some?
set of circumstances. That
I fudded
is not
myself
the
out
situation
of it.
we're in. What we have
Oh, man.
is
I
some
always say
tension
never
between
again,
the
then I
goals,
do it.
and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth.
Still no AI question, man. This is.
Thanks much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends.
There's been no.
Do you agree with that?
I don't have a forecast on that. I
When
don't
we're
know.
thinking about the impact on American households, as you know, they've been facing these higher prices for years.
Is he going to talk about consumer?
They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
AI down to 30s. Wow.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action?
Yeah, I have a big
at your next
replace
meeting? I mean, if we have oil prices,
because he talks about
above
AI,
$100
replacing
a barrel
stuff.
the entire time until the next meeting, is that going to
Replacement
change your
would
wait and
save
see
me.
stance? Like, what would lead you all to move, or is
Yeah, I mean, there's at least 20 minutes
are
probably
you on
left.
hold pretty indefinitely?
We'll have to wait and see.
But yeah, he's managed to. There's been no questions on AI. It's all about oil.
We always say we're going to learn more by the next meeting, and usually we do, but in this case, we're going to learn a lot because we're going to learn 6 weeks to the date till the next meeting. And, we're going to see whether what
Phantom,
happens
this
is-
usually
it's going to be
ends
very important
at
for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And, we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to just remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve?
It's
or
crazy the reporters aren't even saying
even
it
if
wrong.
things remain as they are, the economy can still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just made it's been strong through a whole bunch
I bought some
of
cheap
challenges.
replacement.
If you go back to 2023 when we raised rates a lot,
like 10s, just in case
in 22 and
he
23,
does get an AI question.
and close to 100% of
because
economists
he'll talk
called
a lot about
for
AI
a recession, which
replacement,
didn't
AI
happen. In fact,
replacing.
2023 was a really strong year. So
It's not that. It makes sense. I talked about it in the beginning.
The U.S.
just
economy
because,
has
he's
really
not a
been
political guy.
just doing pretty well through a lot of significant challenges over the past
Here's a shutdown angle. Come on, talk about the.
few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Middle East, man. All right, AI question, please.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court
Wait, he
tariff
hit
decision.
recession? I didn't even see.
And it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty
Say replace.
that tariffs are going to be a one-time price effect?
I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next.
Yeah, Iran at
next year.
7 cents.
They should be a classic one-time thing. People say the same
left.
thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I mean, I think that the theory is probably right. But as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away.
He's saying COVID
and largely
now
for the
instead of
reasons we thought it would, but it took 2 years longer than we thought.
Had to hit pandemic in the beginning.
And
Still hasn't said
so
pandemic.
I think we have to be humble
I
about
died
knowing
at that
how
one
long it will
mention.
take for tariffs to go all the way through the economy. And so what we've been doing
up,
as our staff's
so
been
I'd be doing so well.
It's very interesting. They started off with just an estimate because there wasn't a real history, and then they built based on the history that they're seeing of tariffs coming through into prices. They can now have an arc, and for all the tariffs they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases, and we should start seeing that more and more in the middle parts of the year. We do expect that. Now you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision, but the administration said they're going they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So
Move that
that's how we think
rate,
about it.
really, Powell?
Thank you.
Not replace? Oh.
Hi, thank you.
AI
Chris
question,
Freegaber, Associated Press. You talked about the shortcomings of the SEP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials
Balance sheet,
are
Austin, you
thinking,
can't just look
the
at
ones who will
prior
stay
data.
on for the rest of the year and beyond?
There's a reason he
and
said in the last 70%. We were in a stage
does that even
of,
handicap your successor in any way?
QE or QP
Well, just in
previously.
terms of
we're the balance sheets remain
having a
consistent
whole committee
nowadays, so
expressing its
that's
views.
why it's a
Is
lot
that something
less
that
likely to come
locks
up
them
now.
in for the rest of the year?
No. We had never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction, and so I just think we do it. And I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think, but we don't like to do that just because it's hard to do. We should just keep doing it.
I knew he was going to. Why did I
just
go
would say for
yes,
this one though,
pandemic? Why did I try to flip it?
I think it's
I
more
was
than
trying something
even more than
new,
usual
but
good to
why
take
even
the
try to
forecast
decay
with
flip? Why not just buy
a grain of
yes
salt
pandemic?
because subject to just very high levels of uncertainty.
Brian.
I mean, it's at like
Hi,
90
Brian
now. I probably wouldn't
with
buy
NBC
it at
News.
90.
So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's
Wow, affordability question?
impacting the psychology of the consumer,
No?
especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly, but people are not feeling good about it yet, and it will take some years of positive, real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to the price into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and what it does for us is makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and
I don't think the moment's
stable
over.
prices
You
is
just
half
need
of
to
our
get a question
mandates.
on it, but yeah, it's down to like
one of our two
10
mandates,
minutes
the maximum
left.
employment being the other.
I guess not.
Look at
They don't have to ask an AI
every
question with everything
advanced
going on.
economy that looks anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, pretty much
We're down to like
central bank
10
independence. It
minutes
looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Central bank.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. We're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. In terms of diesel prices, so your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, cost of food and other goods that really rely on it to.
So I think it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those, they're big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this and we don't know how big you just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see. Thank you.
Archie, for the last question.
Last question. Holy.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP. I noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of generative AI.
AI.
We won't know for years what it's really.
He did it. The madman.
But it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of
could he hit
periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity. And by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time, and so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that, and just briefly on that as well to finish up. You hear the argument a lot. This is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down inflation over time. Maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates?
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So
there's AI.
Remember,
again,
in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what high productivity does. Then it actually can be. But I think it's an empirical question because it's really what is the demand growing faster or slower than the supply side.
But he's not talking about labor. Labor is where he would talk about replace
and I think
with AI.
We just don't know that answer ex ante going in. And we'll just have to wait and see. Thank you very much.
That's it. Oh, man. Absolute terrible prediction. Well, yeah, I got to 0 because that was the last question. But wow, the fact he threw in all the AIs at the end. How did I do? We did absolutely incredible. Minus 1,300. Absolute prediction. Dude, man, I played this so bad. I mean, I played it bad, but it was also partly just how it went with this. The strikes I wanted to buy live were mostly, I did want to buy AI live. I guess I should have, but AI didn't really decay ever. It stayed at like 30, 40, even with like a few minutes left. Like it wasn't worth it for that price. The main loss was just freaking pandemic. I got absolutely music in the background. Did you like the music? Oh, wait, could you not hear it because of the music? But I was going to try to flip pandemic. and then I got rinsed on pandemic because he said it right in the beginning. But, I mean, he hit all the bondage strikes. Like he hit all like the high bonds. I mean, the only main one that was missed was softening. That missed. Iran was a huge miss. I knew a lot of people heavy on Iran. And then, yeah, he had some pretty big long shots he hit here, like central bank. Goods inflation, tariff inflation, I was hoping he wouldn't hit early. Yeah, I know, Radar. I was trying to flip pandemic. That killed me in the beginning. He said it once in the beginning, and then he went on to say COVID. So had he not hit there, we probably would have flipped out. But probably should have just bought pandemic, yes, honestly. Felt pretty good about it coming up, given the track record. You flipped off Iran? You were on Iran, yes, originally? Yeah, Iran was very risky strike. But goods inflation and tariff inflation, I was hoping. Surprised he said AI at the end. Yeah, I mean, it's just Q&A based, so if you get a Q&A question or not. Yes, that's why I bought Replace Loxy. But he didn't hit. He wasn't really talking about labor in relation to it. But yeah, recession hit. I'm really upset I wasn't on yes stagflation. That was one I liked. Yeah, but like I liked it because I saw a world it would come up with everything going on, but I wasn't gonna buy it at like 17 cents. So pretty brutal. But man, Powell is gonna get. We only have one more Powell meeting, and then it's gonna be Warsh. The first mention with Warsh is gonna be pretty crazy. Because no one's gonna have data on Warsh. That's gonna be something fun to look forward to. Yeah, Judy Shelton. Yeah, true. Yeah, Shelton. But dude, imagine the first Warsh Powell speech, or the first Warsh speech. I keep saying Powell speech because I'm used to just Powell being Fed chair. No one's gonna have data. That one's gonna be insane. We'll see. Is he gonna be as anti-political as Powell? Well, ladies and gentlemen, thank you for tuning in.